Welcome back to Investing Talk Podcast. This is the deep dive. Today, we are pulling back the curtain on one of the real giants in energy, Exxon Mobil. Our goal here is simple. We're taking all the recent reports, the financials, the market chatter you've shared, and we're going to unpack where this company really stands, right now in mid-2025. Think of it like this. We're doing the sifting for you, highlighting the important stuff, giving you the insights without you having to wade through everything yourself. And hey, if you find this useful, please do subscribe, maybe give us a like or leave a comment. It helps others find the show. And if you feel like supporting what we do, maybe consider buying us a coffee. The link's right there in the description. Okay, let's get into it. Let's start with the basics, a snapshot. ExxonMobil, what's their actual footprint in the energy world look like these days?
Well, they are, as you said, a giant, one of the world's largest integrated oil and gas companies. And that integrated part is really key. It means they do pretty much everything. You've got the upstream side, that's the finding the oil and gas, getting it out of the ground. Then there's product solutions. Think refining crude oil into fuels like gasoline, jet fuel, and also their very large chemicals business. And increasingly, there's this focus on low carbon solutions. So that's where the investments in carbon capture, hydrogen, that sort of thing come in.
Okay, so involved right from the start, finding it, processing it, and now looking at these future energy paths too. How big are we talking globally?
Oh, it's huge. The data shows they produce something like 3% of the world's daily oil. That's quite a chunk.
Yeah.
And if you add in natural gas and their other energy products, it comes out to around 2% of total global energy. The scale is just fundamental to understanding them. And they're known for using technology pretty effectively to, improve efficiency across all these operations.
Wow, 3% of the world's oil. That's significant. A giant with a finger in every energy pie, it sounds like. How's that translated into stock performance, say, over the last year or so, up to now?
Right, the stock. Looking at the numbers around mid-May, the price was just under $105 a share. In the very short term, like the past month, there's been some ups and downs, a bit of volatility with a slight dip noted. Pretty standard stuff, really. If you look back over 6 months, it's been trading in a relatively stable range overall. But like all energy stocks, it's definitely felt the effects of shifting oil prices and, the wider economy.
And what about the full year picture?
Over the last 12 months, the performance actually looks quite resilient, especially when you compare it to some competitors. It's still sensitive to those commodity price swings. Can't escape that in this sector, but it seems to have navigated the choppy waters relatively well. That resilience often points back to their operational strength and that scale we mentioned.
Resilience is definitely a word investors like to hear, but what's the general feeling, the sentiment around the stock right now? Excitement, caution.
I'd say the sentiment seems steady, but probably leaning towards cautious. Investors are definitely weighing the risks inherent in the sector. The commodity price volatility is always there, plus the longer-term questions about the energy transition. They're balancing that against the company's, solid operational track record and financial health.
Got it. Steady, cautious, but resilient. Let's dig into that financial health you mentioned. What did the first quarter numbers for 2025 tell us?
Yeah, Q1 gave us a pretty good look. The key number, net income, came in around $7.7 billion. That worked out to earnings per share, or EPS, of $1.76. And what's interesting there is that the EPS figure actually beat the average analyst estimates by about 2%. Not huge, but beating expectations is generally seen as a positive sign.
Okay, profits strong, better than expected. What about revenue, the top line?
Revenue for Q1 was $83.13 billion. Now, that number was actually slightly under what analysts were predicting. And the analysis points out that revenue growth overall has been a bit volatile recently, which, again, isn't too surprising for an energy company. It really depends heavily on those global prices for oil and gas and demand.
Right. So strong profits despite slightly lower than expected revenue, likely due to efficiency.
That seems to be the picture. Their operational efficiency helps protect the bottom line, even when the top line moves around with commodity prices.
Makes sense. And beyond the profit number, what about the actual cash they're generating, free cash flow?
Cash flows. That's definitely an area of strength highlighted in the analysis. Free cash flow, or FCF, was really robust in Q1, about $8.8 billion. And the analysis emphasizes this isn't just a one-off. Their FCF has been consistently strong over the last few years. This comes down to, disciplined spending on big projects and those ongoing operational efficiencies. Strong FCF is vital, gives them options.
Options like paying down debt, investing, or returning cash to shareholders, right? What about their balance sheet and those shareholder returns?
Exactly. That strong cash flow definitely supports a healthy balance sheet. The data suggests they keep a pretty conservative capital structure. Their debt-to-equity ratio tends to be around, or sometimes even below, the industry average. So they seem to manage their debt quite prudently.
Good to know. And how are they using that cash flow to reward investors? Dividends, buybacks?
Oh, they are definitely rewarding investors. It's a major point.
Yeah.
In Q1 alone, they returned $9.1 billion. That's huge. That broke down into $4.3 billion in dividends and $4.8 billion in share buybacks. And the analysis really flags their aggressive capital return program. They're targeting $20 billion for the whole of 2025. That really stands out because some of their peers have actually been scaling back on buybacks recently. Plus, they have that dividend aristocrat status, meaning they've increased their dividend for, well, over 25 years straight. That's a big deal for income investors.
Wow, $20 billion target for the year. That's substantial, especially if others are cutting back. How does the market value them then? Things like the PE ratio.
Right, valuation. Their price-to-earnings ratio, the PE, typically seems to hover between 10 and 13 times earnings. That's generally seen as being in line with the broader energy sector, sometimes maybe a touch lower. It reflects both the value people see, but also the cyclical nature of the business. And the price-to-book ratio is usually around 2 to 3 times. That suggests the market values their actual assets, their infrastructure, quite highly compared to what's on the books. Often points to quality assets.
And volatility. How does the stock price move compared to the overall market? Big swings.
We look at beta for that. Their beta is reported as being around 1 to 1.15. A beta of 1 means it moves with the market. So 1 to 1.15 suggests it's moderately volatile, maybe slightly more so than the S&P 500 index on average. Not wildly unpredictable, but not a low volatility play either.
Okay, so financials look sound. They're returning a lot of cash. Valuation seems reasonable for the sector. Moderate volatility. Let's shift gears slightly. Beyond the numbers, what are the core business strengths giving them an edge?
Several things stand out. First, just sheer economies of scale. Being that big allows cost efficiencies others can't easily replicate. Second, that huge global asset base, having resources and facilities all over the world. And third, their ongoing investment in technology. Not just refining oil, but in complex refining and chemical processes, which can be quite profitable. They hold leading market positions in many of these areas and often get praised for just being very good at the complex job of running these massive operations efficiently. Execution matters.
Leveraging size and know-how. But you mentioned earlier they're not just sticking to the old ways. What about recent strategic moves, new projects?
Correct. They are definitely making moves. One significant recent development was starting up a new chemical complex in China. That's a clear strategic push into a key growth market for chemicals. They've also launched an advanced recycling unit. This is interesting. It signals they're adapting to, circular economy ideas, finding ways to deal with plastic waste.
Advanced recycling feels like a necessary move these days. Now, what was that specific news item that seemed to give the stock a bit of a lift recently?
That was likely the news about them showcasing advancements in battery technology. This happened at a major European industry event. It wasn't just a small mention. It highlighted their research and development in energy storage. That's pretty distinct from their core oil and gas business, but obviously very relevant to the future energy mix.
Battery tech from Exxon Mobil. That definitely sounds noteworthy. How did the market react?
It seems like it was received very positively. Investors appeared to see it as real evidence that management is serious about adapting for the long term, diversifying into lower carbon areas.
Yeah.
It definitely seems to have boosted confidence.
Interesting. Any other recent wins or strategic things going on, internal stuff, maybe asset changes?
Yes, a couple other things mentioned. They received 2 internal awards for operational excellence. One for managing a big maintenance project efficiently, another for an energy-saving project. Little things, maybe, but they reinforced that focus on execution. Also, they announced plans to sell their Gravenchon refinery over in France. This looks like part of a bigger plan to streamline their portfolio, focusing on assets that are maybe more profitable or fit better with their long-term view. That sale should close early next year.
Okay, so optimizing the core, expanding in chemicals and recycling, making noise in battery tech, all while keeping an eye on efficiency. But no company exists in a bubble, right? What are the big picture challenges, the industry headwinds they're facing?
Absolutely. The biggest one, no question, is the energy transition. The global push to decarbonize puts long-term pressure on fossil fuel demand and brings a lot of regulatory uncertainty. Then there's the constant factor of commodity price volatility. Oil and gas prices can swing wildly, impacting profits and planning. That's just the nature of the business.
And how do they stack up against the other supermajors like Chevron or Shell in dealing with all this?
Well, the comparison shows some similarities, some differences. Things like PE ratios, dividend yields might be in the same ballpark. But for example, their debt levels might be lower than Shell's, maybe a bit higher than Chevron's, based on the snapshots provided. But a key differentiator that keeps coming up is that commitment to shareholder returns. ExxonMobil has kept its buyback program going strong, increased dividends, while, as we noted, others like Chevron have trimmed buybacks and BP made significant cuts.
So that's a strategic choice, sticking with those big payouts even while they're investing in things like batteries and carbon capture.
That certainly seems to be the strategy highlighted. They're trying to balance rewarding shareholders heavily now, using the cash from their traditional business, while also making these steady investments in lower carbon areas. It's a specific kind of balancing act.
Okay, so what are the main risks investors really need to keep on their radar with ExxonMobil right now?
Regulatory risk is high on the list. Climate policy changes, carbon taxes, stricter environmental rules. These could all impact their bottom line. There's also mention of potential litigation risk, related to historical environmental issues. That's always kind of lingering for major energy companies. Supply chain disruptions are always a possibility for a global company, though apparently haven't been a major issue recently. And of course, geopolitics. Instability in oil-producing regions is an inherent risk, though nothing specific and new was flagged as an immediate major threat in the recent analysis.
Regulatory, environmental, market volatility. The usual suspects for the sector, but still very real. We touched on the positive reaction to the battery news. What's the wider sentiment like among analysts and, say, on social media?
Analyst sentiment seems to lean generally favorable. They appear to like the combination of seeing tangible progress on the sustainability front, the battery tech, the recycling, while the company continues to turn out really strong cash flow from its core businesses.
And what about on platforms like X? What's the buzz there?
Investor chatter there was reportedly quite positive, especially after that battery tech news. A lot of people seem to take it as proof management is serious about adapting long term. There's sort of a cautious optimism around the dividend that people feel is pretty safe for now. But there is also some skepticism floating around about just how much growth they can achieve long term, given all those pressures we talked about. The analysis also mentioned some unverified rumors popping up, things about more asset sales or maybe partnerships, but strongly cautions against trading on rumors.
Right, always be careful with unverified stuff. So it sounds like the recent positive stock movement wasn't just one thing, but a few factors coming together.
That's a good summary. The analysis suggests it's a combination. The positive reception for the battery innovation, the internal nods for operational excellence, the strategic streamlining like the refinery sale, that continued strong shareholder payout commitment, and just generally improved confidence that they're managing to balance the old and the new effectively.
Okay, let's try and bring this all together then. Looking at everything, the finances, the strategy, the risks, the sentiment, what's the overall outlook? What's the takeaway recommendation from the analysis?
Based on all the data looked at, running up through mid-June 2025, the summary recommendation comes out as a hold on the stock.
A hold. Okay, why not a buy? Or maybe even a sell? What's the thinking behind hold?
Well, the rationale seems to be that ExxonMobil offers really strong income stability. That robust free cash flow lets them keep paying those significant dividends and buying back stock, even when competitors might be pulling back. So for an investor whose main goal is reliable income, it looks quite attractive. However, the hold reflects those persistent risks, the macro uncertainties, the commodity price swings, and the whole regulatory landscape around decarbonization. Those haven't gone away.
So good for income seekers, but maybe question marks around future growth potential given the headwinds.
That's essentially it. For investors focused primarily on growth, the advice is a bit more watchful. The analysis suggests closely monitoring their actual progress on those low-carbon projects, carbon capture, hydrogen, batteries. See how they develop, compare them to pure-play renewable companies, or maybe more diversified energy players before committing more capital purely for growth. Can these new ventures really move the needle for such a huge company?
That makes sense. So given that hold view and the need to monitor progress, what are the key things we should be watching for in the near term? What could change the picture?
There are a few key things. Upcoming quarterly earnings reports are always crucial. Do the numbers stay strong? Any updates on the low-carbon initiatives will be closely watched. Also, any significant M&A activity in the sector could potentially involve them and change the story. On the downside, The main risks to watch are renewed weakness or big swings in oil prices that directly hits profits. And of course, any major new regulations targeting fossil fuels would be a significant negative catalyst.
Okay, so there we have it. A pretty thorough look at ExxonMobil based on the recent analysis. It's definitely a company navigating some tricky waters, strong traditional business, but making clear moves into new areas.
It really is a balancing act, isn't it? Generating huge amounts of cash from oil and gas, returning a lot of it to shareholders, while also investing in efficiency and these lower carbon solutions for whatever the future holds. It's a complex allocation challenge.
It certainly is. And as you said, while this gives us a good snapshot now, mid 2025, the energy world never sits still for long.
Which kind of leaves us with a big question, doesn't it? Given the sheer scale of their traditional operations and this constant tension between funding that and funding the transition, can a behemoth like ExxonMobil truly transform itself fundamentally? Or is it more about optimizing the legacy business while adding some potentially valuable but maybe still peripheral future-facing projects?
A fundamental transformation versus optimization with some additions. That's definitely something to ponder as you follow their journey. We hope this deep dive has helped clarify things and provided some valuable perspective from the materials we reviewed.